It's funny how we have these strange habits. Think about a garden. You're always so quick to pick the beautiful, ripe tomatoes, right? But those withered, struggling plants, you kind of leave them in the ground, just hoping they'll turn around. Well, it turns out investors do the exact same thing with their stocks. And folks, it's one of the most common and costly mistakes we make. So today, we're going to dive deep into what a huge study revealed about why on earth we do this with our money.
And that really is the central puzzle, isn't it? It feels completely backward. I mean, logically, you'd think you'd want to cut your losses short and let your winners run as long as possible. And yet, for decades, researchers have noticed that we tend to do the exact opposite. We cash in on our profitable investments way too early, while stubbornly clinging to the ones that are bleeding money. It's a real head-scratcher. Why do we do it?
Well, this thing, it's not just some random quirk. It actually has a name. Researchers Hirsch, Chafin, and Meir Statman officially called it the disposition effect. It's this powerful, almost built-in tendency to sell the good stuff and hold on to the bad. Now, to find out just how real and widespread this is, we've got to look at the hard evidence.
And that brings us to this absolutely groundbreaking study by a researcher named Terence O'Dean. He really put this whole idea to the test. And he didn't just, ask people what they thought they did. No, he got his hands on the actual, real-deal, anonymous trading records from a major brokerage firm to see what investors were really doing.
And the sheer scale of this research is what makes it so incredibly powerful. We are not talking about a small survey or a handful of accounts here. O'Dean analyzed almost 163,000 individual trades across 10,000 different accounts over a 7-year period. A data set that massive gives us an almost perfectly clear picture of how we actually behave with our money.
So what did all that data show? Well, the evidence was pretty undeniable. On any given day, these investors sold about 14.8% of their stocks that were in the green, their winners. But when you looked at their losing stocks, they only sold 9.8% of them. The numbers don't lie. People are way, way more willing to lock in a gain than they are to accept a loss.
Let me just put that in even simpler terms for you. On any random day, a stock that had gone up in value was more than 50% more likely to be sold than a stock that had gone down. That is a massive behavioral tilt, a huge subconscious preference for selling your winners.
But hang on a second. Before we jump to conclusions and just call this irrational, could there be a perfectly logical reason for this? Something smart investors would do? Let's play detective for a minute and investigate some of the most common rational explanations.
Okay, suspect number 1, portfolio rebalancing. Now, this is a totally smart strategy where you sell a bit of a stock that's grown really big in your portfolio to keep things balanced and diversified. So it makes sense that you'd be selling a winner in that case, right? So could that explain this whole thing?
This is where the study gets really clever. O'Dean reran the numbers, but this time he only looked at trades where an investor sold their entire position in a stock. Now think about it. Selling everything isn't rebalancing. That's just closing out your investment completely. And guess what? The effect was still there and just as strong. Investors were still way more likely to sell all of a winning stock than all of a losing one. So nope, rebalancing wasn't the main driver.
All right, suspect number 1 is out. What about motive number 2? Maybe these investors are just brilliant contrarians. Maybe they're holding on to those losing stocks because they have a totally rational belief that these stocks are due for a big comeback, and they're going to outperform the winners they just sold. Is that belief actually justified by the facts?
Well, the data gives us a cold, hard answer. And honestly, it's kind of a painful one. O'Dean looked at what happened in the year after these investors made their decisions. The winning stocks they sold, they actually went on to beat the market by an average of 2.35%. And the losing stocks they so stubbornly held on to, they underperformed the market by about 1.06%. So on average, their belief was just completely wrong. The stocks they sold did better than the ones they kept. Ouch. So if it's not rebalancing, and it's not some savvy belief in a comeback, then what in the world is really going on? With all the rational motives debunked, we have to look deeper. We have to look into the psychology of how our brains are wired to handle risk, gains, and most importantly, losses.
And the main culprit, it turns out, is a Nobel Prize-winning idea called prospect theory, developed by the psychologists Daniel Kahneman and Amos Tversky. It really boils down to 2 key things. First, we are wired to hate losing way more than we love winning. The pain of losing $100 feels about twice as strong as the joy of gaining $100. And second, we judge everything based on a starting line, what they call a reference point.
And for an investor, what's that big, important reference point? It's simple. It's the price you paid for the stock.
That number gets burned into our minds. Anything above that price feels like a gain, and anything below it feels like a loss. And this one little psychological anchor, it changes everything about how we make our decisions.
See, this mental anchor creates two completely different zones that change how we think about risk. First, you've got the gain zone. When a stock is above your purchase price, you get nervous, you become risk-averse. The feeling is, phew, I'm ahead. I better not risk this. Let me just take the sure win and sell now. But when the stock price drops into the loss zone, below what you paid, your brain flips a switch. You suddenly become a risk seeker. The thought process changes to, oh man, I can't sell now and make this loss official. I'm just going to hold on and gamble that it might get back to even.
And this quote from Kahneman and Tversky, the guys who came up with the theory, it just nails it. A person who has not made peace with his losses is likely to accept gambles that would be unacceptable to him otherwise. That refusal to make peace with the loss, to make it real by hitting the sell button, it pushes us to take a risk, like holding a falling stock, that we otherwise wouldn't. It's an emotional decision, not a financial one.
Okay, so this is all really fascinating psychology, right? But does it actually matter? What does it really mean for an investor's wallet? Because this isn't just some academic thought experiment. The disposition effect has a very real and very measurable financial cost. So let's just spell out the financial consequence of that choice in plain black and white. When you give into this bias and you sell your winner, you are, on average, walking away from a stock that is going to beat the market over the next year. And at the same time, by holding on to that loser, you are, on average, shackling your portfolio to a stock that's going to lag the market. You are systematically selling your best players and keeping your worst on the field.
So what's the total damage? What's the final bill for this little psychological hiccup? Well, when Odin calculated the combined effect of this performance drag, plus the negative tax consequences of it all, he found that this one behavioral bias cost the average investor about 4.4% in returns over the following year. That is a staggering, completely self-inflicted financial wound.
And, as if that weren't bad enough, there's a final twist of the knife here. This behavior is the exact polar opposite of a smart tax strategy. A smart tax strategy is to harvest your losses, to sell losing stocks to offset the taxes on your gains. But the disposition effect makes us do the exact opposite. We realize our gains, which creates a tax bill, and we hold on to the very losers that could have helped us lower that bill. It's just a financial double whammy. So the whole point of this explainer is this. The disposition effect is a powerful default setting in our brains. It feels right to sell a winner and hope a loser recovers. It feels comfortable. But the evidence shows that this feeling is very often a trap, and the best defense against it is just knowing that it exists. So the final question isn't for me, it's for you. Now that you know this bias is probably nudging your own decisions, how are you going to look at the losing stocks in your portfolio tomorrow?